Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Value Investing, Warren Buffett's Timeless Strategy Explained. Analyzing financial statements. Understanding financial statements is crucial for Buffett. These documents provide a wealth of information about a company's health and performance. Key financial ratios and balance sheets serve as windows into a company's operations. Profitability ratios. Metrics such as return on equity, ROE, and profit margins allow investors to gauge how effectively a company generates profit compared to its sales or assets. Liquidity ratios. Current and quick ratios help assess a company's ability to cover its short-term liabilities, an important indicator of financial stability. Debt ratios. The debt-to-equity ratio shows how much leverage a company uses. High levels of debt can be risky, especially in tough economic times. Buffett emphasizes the importance of digging into these numbers. He seeks companies with strong fundamentals that indicate stability and growth potential. If the numbers tell a positive story, he feels more confident about investing. Long-term versus short-term investing. Buffett's investing philosophy hinges on a long-term perspective, which contrasts sharply with many short-term trading strategies. While day traders often seek quick profits from price fluctuations, Buffett champions the idea of buying quality companies and holding them for years or even decades. This long-term focus allows Buffett to ride out market volatility and capitalize on a company's growth potential. Consider this. A patient investor can weather the ups and downs, similar to a farmer tending to crops through seasons. They understand that the harvest may take time but is ultimately worthwhile. Short-term traders, by contrast, often face greater risk and stress. They might react impulsively to market news, leading to potential losses. Buffett's method encourages a steady hand and the ability to make informed decisions based on solid research rather than emotional reactions. The role of economic moats. A concept central to Buffett's strategy is the idea of economic moats. An economic moat refers to a company's competitive advantage, the features that protect it from competition and help maintain market share. Buffett looks for businesses with strong moats, such as brand recognition. Companies like Coca-Cola benefit from a well-established brand perceived positively by consumers. Cost advantages. Businesses that can produce goods more cheaply than competitors can maintain profitability even in competitive markets. Network effects. Companies like Facebook and Google become more valuable as more people use their platforms, creating a cycle of growth that's hard for competitors to break into. These moats create a barrier that leads to sustainable profits. When Buffett finds a company with a strong moat, he's more likely to invest, believing it will continue thriving over the long term in a competitive landscape. Understanding economic moats equips investors to identify businesses that can weather market challenges and deliver reliable returns. Lessons from Warren Buffett's success. Warren Buffett's investment strategies offer foundational lessons for anyone looking to improve their approach to investing. Two key components of his philosophy stand out: patience and discipline, along with an understanding of market psychology. By embracing these elements, you can enhance your ability to make smart investment choices. Patience and discipline. Investing requires a significant amount of patience and discipline. Buffett exemplifies this through his long-term commitment to investments. He often says that time in the market beats timing the market. This idea encourages investors to hold on to quality stocks, even during market downturns, believing that their value will increase over time. Consider the journey of planting a tree. Just as a tree takes time to grow, so too do investments require nurturing and care. Instead of looking for quick returns, focus on the fundamentals and allow your investments to mature. Over time, the benefits can be substantial. Discipline plays a crucial role in maintaining that long-term perspective. It's easy to get swayed by market fluctuations and news headlines. Sticking to a well-researched plan helps investors avoid impulsive decisions that can lead to losses. Create a strategy based on your investment goals and stick with it, even when the market gets rocky. Understanding market psychology. Being aware of market psychology can significantly influence your investment decisions. Buffett often advises investors to be fearful when others are greedy and greedy when others are fearful. This counter-cyclical approach lets you spot opportunities when most are running for the exits. Market sentiment drives stock prices more than fundamentals at times. Fear and greed can create significant price swings, leading to undervaluation of good companies. By understanding these emotions, you can identify when a stock is trading at a discount, not because of its fundamentals, but due to prevailing market fears. Think about how people react in a sales situation. When everyone rushes to buy a product, prices can skyrocket, often leaving quality items behind. Conversely, when fear sets in, quality stocks may be sold off unjustly. By keeping your emotions in check and focusing on the fundamentals, you can make more informed investment choices. In essence, incorporating patience and discipline into your investing approach, along with an awareness of market psychology, can pave the way for a more fruitful investment experience. Remember, true investing is not a sprint, it's a marathon. Challenges in value investing. Value investing, despite its potential rewards, comes with its own set of challenges. Understanding these obstacles can help investors prepare and make better decisions. Below are two major challenges that value investors often face. Market volatility. Market fluctuations can create a challenging environment for value investors. Prices can swing rapidly due to economic indicators, geopolitical events, or even rumors. During these times, a company's stock might drop significantly, even if its fundamentals remain strong. This can lead to frustration for value investors who believe in the intrinsic value of their holdings. Consider a situation where you've invested in a solid company with a strong track record of earnings. Suddenly, the market reacts to a minor headline, causing the stock to plummet. This is where patience comes into play. Many investors might panic and sell, questioning their analysis. Market volatility can stress even experienced investors, driving them to make hasty decisions against their better judgment. To counteract this, it's essential to maintain a long-term perspective. Focus on the company's fundamentals instead of short-term price movements. A well-researched investment should weather these storms. Remember, the stock market can be irrational, but the company's true value will eventually come to light. Finding true value. Determining a company's intrinsic value can be quite tricky. Even experienced investors may struggle to accurately evaluate a stock's worth. It's not merely about looking at financial statements. You must analyze the company's competitive position, industry trends, and future growth potential. This process is often subjective and can vary from one analyst to another. Take a well-known company that appears undervalued. Without thorough research, it's easy to jump to conclusions. What if you miss crucial factors affecting its future cash flows? This can lead to misguided investments where you believe you're getting a bargain, but instead, you're facing an impending decline. Investors should take the time to study not just the numbers, but what drives those numbers. Engage in qualitative analysis, assessing management capabilities, industry landscape, and economic moats. Relying solely on traditional metrics without considering the bigger picture can make it hard to uncover true value. In summary, challenges such as market volatility and the difficulty in assessing intrinsic value can test the resolve of value investors. However, understanding these hurdles and preparing for them can empower you to make more informed decisions. Conclusion. Warren Buffett's value investing strategy highlights the importance of patience, research, and a long-term perspective. By focusing on a company's fundamentals and looking for stocks that are undervalued, investors can build a more stable portfolio. His principles remain effective today, guiding many through the unpredictable stock market. If you're considering investing, take the time to explore value investing further. It might just be the approach that leads to long-term success. As Buffett himself said, the stock market is designed to transfer money from the active to the patient. Are you ready to become a more patient investor? Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.